Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. Today, the Bank of Canada released its quarterly monetary policy report, where it outlined a number of predictions for Canadian real estate and the Bank of Canada's inflationary predictions. First part, 1 hour later, the Bank of Canada Governor Tiff Macklem held a press conference where he answered reporters' questions and also outlined or reiterated his vision for the Canadian economy as we're looking more and more like we're moving out of COVID. Hopefully. So what I want to do today is go through the predictions made by the Bank of Canada in its monetary policy report for the Canadian real estate market. I then want to go through some less optimistic predictions, to say the least, on Canada's inflationary data. And then finally, I want to go through some new sections that I found in the policy report, which I think gives us a hint on where the Bank of Canada thinks we should be directing our attention as we look to see what the economy will look like in the coming years ahead. A quick hint, it looks from the monetary policy report as though China is going to maintain a large focus on the part of the Bank of Canada, and we have a weekly China update coming out on Friday, so make sure you click like and subscribe to get those updates. But for now, let's get into those real estate predictions. The Bank of Canada's monetary policy report seems to stress that as far as Canadian real estate goes, it looks like we are going back to normal. Back to normal not in prices, not as in pre-pandemic prices, but the relative stability of our prices are looking like they're going to be going back to normal based on this monetary policy report. The bank stresses, one, that new construction should help fill a lot of the void that was left from the lockdowns throughout the pandemic, as more and more housing starts will help to ease some of the supply issues that have been so prominent and caused our prices to go up so high. They do note that multi-unit starts have been way up, although single-family starts have slowed down a little bit. But the construction of apartment buildings and other multifamily units will help to ease the supply constraints that have helped push the price of Canadian real estate up so high in the past few years. It also notes that many of the pressures boosting up demand throughout the pandemic, people having to stay home, wanting more space, wanting that extra office, maybe a pool, etc., are starting to ease more and more as that vaccination rate goes up. And the amount of time that Canadians are spending locked down in their homes decreases substantially.
Time's up, Boggs.
So a lot of the pressures that were causing Canadian real estate to go up so high in price are starting to subside as we're basically opened right up, and many of the restrictions that we had previously are gone. Ontario just removed most of our restrictions on restaurants and bars and gyms just this week. So with people being able to go out more and more, their demands for a bit of a better home life, I suppose, a bit of a more comfortable home life, are starting to subside a bit. With that in mind and that return to normal, the Bank of Canada is predicting that housing won't make up such a large portion of our GDP growth into the future. If you'll remember, throughout the pandemic and the lockdowns, the real estate sector did a lot of the heavy lifting for our gross domestic product, as real estate was one of the few industries that could continue during lockdown, what with virtual signings, virtual open houses, etc. It accounted for a large portion of our GDP. But like we said, back to normal, it does look like it's going to constitute a much, much smaller portion of our GDP going forward. So between the new construction, the pandemic-related demand going down, and real estate constituting a much smaller portion of our GDP, as far as the Canadian real estate sector goes, the Bank of Canada is predicting that we're basically going back to normal, back to what we had expected, how things were pre-pandemic, which will be a sign of relief, I think, to a lot of first-time home buyers, as the lack of construction and the increase in demand have, in large part, helped to drive our prices up massively over the past couple of years. So that's going to be great news to a lot of first-time home buyers. What won't be such great news to Canadians at large are the inflationary data predicted by the Bank of Canada and Tiff Macklem, who predict that by the end of 2021 we should be seeing inflation data in that 5% range.
In Canada, inflation is currently running at about 4.5%. We now expect it to rise to close to 5% by the end of this year.
Given that the bank wants to see inflation in and around that 2% range, 5% is huge. The U.S. recently posted 5% inflation, and economists and onlookers, investors went nuts, with multiple accounts calling for an increase in interest rates. So if our inflation data does hit that 5%, we can most definitely expect to see higher interest rates going into 2022, which the Bank of Canada in the report even suggests that we will probably see within the second to third quarter of 2022.
In view of the continued excess capacity in the economy, my fellow governing council members and I judged that the economy still needs considerable monetary policy support. While we ended QE, we kept our policy interest rate at its lowest level and reaffirmed our commitment to keep it there until slack is absorbed so that the 2% inflation target is sustainably achieved. Based on our current projection, this happens sometime in the middle quarters of 2022.
So it looks like the period of ultra-low cheap money is coming to an end within the next year, at the latest. The bank does say sooner rather than later we will be seeing a raise in the policy rate. But this is everything remaining equal, and as I think this report shows, not all is equal. You may have heard, especially if you're a subscriber to this channel, that there's been some major issues in China lately, with supply shortages, an energy crisis, as well as a real estate crisis, as there have been multiple defaults on their real estate market, and major downturns in their economy. Although this channel has been focusing on it, and they were seeing a little bit more and more of China news in the mainstream media, the Bank of Canada, judging by this report, has definitely turned its sights onto China. The previous monetary policy report, released in July, had China mentioned 9 times, and there wasn't a whole lot of analysts that paid major attention to China as of the release of that report. Fast forward 3 months later, and China is mentioned 19 times in this monetary policy report, paying nearly over double the attention to China as they had in the previous report. So obviously the Bank of Canada has its eyes set on China, and I do want to release a separate video directly related to what the Bank of Canada has to say about China in the report. But suffice to say right now that the Bank of Canada, at least what they're saying publicly, has doubled their interest in what is going on in China, as I think it's becoming more and more obvious that the supply chain issues, the real estate crisis, which I think is going to be a big one, are going to have a major effect on our economy here in Canada. So I will be doing a separate video on the reports focused on China. But for now, for this report, I just think it's definitely worth noting that there is being an increased amount of attention paid towards the Chinese economy and the developments happening there. So all in all, from this report, we do have some good news with real estate set to go back to normal. We do have some disheartening news with inflation set to go up even higher than it was before. The inflation data released just last week showed us at 4.3%, which was our highest since 2003. A 5% inflation rate is going to be even more painful for a lot of people, and that's definitely not good news, both for consumers who have to pay the prices and for mortgage borrowers and real estate buyers who will have to pay the higher interest rates as the Bank of Canada attempts to tamp down that inflation and cool down our economy a little bit once we get back to more and more normal. We went from the new normal to the more normal. We'll see what happens. We will have an update out, as I mentioned, on the Bank of Canada's focus on China, as well as our weekly update on the Chinese real estate crisis as it unfolds. And we're already starting to see this week that there have been some more defaults and some even more issues going on with Chinese real estate. So click like and subscribe to get those updates, and thanks so much for watching.